Good day to all, my name is 𝗬𝗃𝘃, Assistant Manager from iFAST Research Team. Asian high-yield bonds have been a topic of interest lately, and many investors are wondering if now is the right time to return to this market. However, there are several factors that suggest that caution is still warranted. Earlier this year, we expressed our belief that the rally in Asian high-yield bonds seen last November would not be sustainable, and we still maintain a defensive stance for several reasons. One major concern is the underperformance of China within the Asian high-yield bond market since the property crisis in 2021. This situation highlights the risks associated with relying heavily on a single sector. The recovery of the China property sector is crucial for the overall outlook of Asian high-yield bonds, but it is still early to predict a quick turnaround. The pent-up housing demand that initially drove the sector's recovery is beginning to fade, and liquidity concerns surrounding property developers have resurfaced. Furthermore, the restructuring plans of developers who have already defaulted have faced obstacles and have not always progressed smoothly. Looking ahead, we believe that India will play a larger role in driving the performance of Asian high-yield bonds in the long term. India has proven to be a relatively resilient player in the bond market, supported by its two largest sectors, renewable energy and industrials. Considering these factors, investors who wish to maintain exposure to Asian high-yield bonds may want to consider our recommended fund, BlackRock Asian High-Yield Bond Fund. Active security selection could help in identifying higher quality names with robust balance sheets. Relative to the Bloomberg Asia USD High-Yield Bond Index, the fund holds a larger position in the Indian high-yield space. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Colin will share with us more about SingPost's bonds. Over to you, Colin.
Hi, my name is Colin, Portfolio Manager at iFAST Bond Research Team. SingPost's, the Singaporean postal service provider, has recently experienced a credit downgrade by S&P Global Ratings, raising concerns about the attractiveness of its bonds. The downgrade from BBB+ to BBB reflects a deterioration in SingPost's credit profile. Profitability for the group has been under pressure after its pivots towards the more competitive Australia-focused logistics business, while the traditional post and parcel business faced a structural decline. Given these circumstances, it is understandable that investors are seeking better alternatives to SingPost's bonds. The current outlook suggests that earnings will remain challenged in the near term, with a potential rebound anticipated in the latter half of the fiscal year 2024. The overall credit profile of SingPost has also weakened due to increased leverage. However, it's worth noting that the company still maintains a robust liquidity and cash flow, and we think the group should have no issue meeting debt obligations in the short term. When comparing SingPost's two senior unsecured bonds, the 3.23 bond appears to be a more favorable option. The 2030 bond only offers a 3 basis point yield pickup for a 3.64-year difference in remaining time to maturity. In terms of perpetual bonds, ESR Group's 5.65 perps seems to be a better option than the SingPost perps. The ESR perp offers a higher yield, which can be appealing to investors seeking higher return. However, it is essential to note that perps carry a certain risk, such as no fixed maturity date and the possibility of the issuer not redeeming the bond. It is crucial to consider the risks associated with SingPost's credit downgrade before making any investment decisions. The downgrade reflects the business challenges the company faces. However, SingPost's liquidity and cash flow remain strong, indicating that the company has the capacity to weather these challenges. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.